Hey guys, welcome back to another video. Today we're going to be talking about net working capital and the necessary valuation adjustments when valuing that business. Now this is quite an important topic, especially in the real world. It's not covered at the undergraduate level, and really I came across this subject when reading a few articles in the Canadian Institute of Chartered Business Valuators journal. So this is a much more advanced topic, but very, very important, because when it comes to working capital, there's a lot of value, a lot of cash tied up in working capital that is misvalued and undervalued, especially when using cash flow analysis metrics and valuation methods like the discounted cash flow model. And so we'll go into it and really talk about how people overlook this and how to really properly account for the value of net working capital. So let's get started. So working capital is the difference between current assets and current liabilities, which is used by the business to run its day-to-day operations. When valuing businesses through the traditional discounted cash flow approach, the DCF approach, the calculated value is the enterprise value of the business. Now, enterprise value is the total value of the business's operating assets attributable to both debt and equity holders. Non-operating assets are not valued in enterprise value. So this makes sense. Think of the DCF model. It projects the free cash flow generated by the business and calculates the present value of these earnings. Now, non-operating assets, especially those that don't generate revenue on their own, which could be real estate holdings for the company, do not account for these projected cash flows. So theoretically, they are not valued and accounted for in the model. Now, the best way to look at it is think of a business that has a core service business that generates revenues and additional real estate interests that either they house their operations on, or they just hold in a separate portfolio and maybe collect a little bit of revenue from, but not enough. So that asset is completely unaccounted for when you are building a DCF model in order to project the core earnings of the business. The core earnings originate from the services side. So really, you're projecting the free cash flows of that services business. And especially if those non-operating assets don't produce any revenue, then they're not properly accounted for in the final calculation. That final projection is the enterprise value of the business. In real-world situations, the value of net non-operating assets needs to be accounted for, and that's why there's a difference between enterprise value and total enterprise value. So EV versus TEV, and I've already made a separate video on that on my channel. But TEV essentially takes the enterprise value of the business plus the value of non-operating assets, right? And so that's a clear distinction. Now, looking at that, we can actually go further and talk about working capital, which is similar, because working capital is not accounted for in the valuation of enterprise value. At the end of the day, we account for the changes in working capital, but we don't account for the actual stock value of that working capital, especially from the starting point. Because what if working capital is more than we need it to be? Which is essentially what this video is about. Well, what about that extra value? Is that properly accounted for in the enterprise value projected by the DCF model? No, it's not. And therefore, you need to make an adjustment in order to account for that. And so I'm not going to, this adjustment is irrelevant when it comes to asset value calculations. If you're calculating the net asset value of a business, the working capital of the business will properly be accounted for. But with a DCF model, you're not accounting for the asset value of the business. You're calculating the enterprise value of the business, which is very important. Once again, is the total value of the business's operating assets attributable to both debt and equity holders. So it's the business's operating assets, its core business. And so the non-core assets are not accounted for. So let's consider a working capital example. The DCF model projects the cash flows of a business based on the appropriate expectations agreed upon by the acquirer's advisory team following due diligence. Now, based on this analysis, the inventory needed to run the business at this growth rate, the projected growth rate based on that due diligence, is $100. But what if the company took advantage of a order discount, or due to some outside external factor, it now actually holds $200 worth of inventory? Well, if we only need $100 in inventory to really run the business at the projected growth rate, that extra $100 in inventory will not be properly valued in the DCF model. So while the DCF model, through its free cash flow calculation, accounts for changes in net working capital, it actually doesn't account for the starting value of inventory without proper adjustments. And those are the adjustments that we'll talk about in this video. So it is important to remember, as a business grows its sales and operations, the liquidity and asset base, thus its working capital, must increase to account for this expansion in earnings. But if there is excess inventory, then some of that valuable stock is not accounted for in the final value projected by cash flows. Therefore, this video will consider how to view this potential discrepancy to either fairly reward the seller with a higher purchase price or alert the buyer of the extra investment needed to fund working capital to meet projections. And so this is very important because the risk is, say for example, in the previous example, there's extra stock value. Well, the owner of that business, the seller of that business in this scenario, in an M&A scenario, they have already invested cash, hard-earned cash, from that business back in to buy more inventory. Well, if they've bought more inventory than is actually needed, that extra value needs to be accounted for, and therefore they should increase the purchase price of the business to fairly compensate the seller. Now, the opposite end is, what if the business only has $50 of inventory and it needs 100 to actually meet expectations? Well, if the buyer doesn't really understand that, especially if it's an inexperienced buyer, then what will happen is they buy the business and they're like, well, we want to run it at this growth rate. Oh, well, sir, we need more inventory. Well, what do you mean? I just bought the business. Doesn't it have inventory? Well, no, we need more. And so all of a sudden, not only you're buying and paying that cash outflow to acquire the business, but then you have to increase your investment in that business by injecting more capital, which therefore you need to adjust the purchase price lower in order to account for that increased capital investment following the acquisition. So that's really important. Now, in a transaction setting, working capital accounts can fluctuate until the closing date and may wind up at a level that is not normal for the existing business, which was not expected by one of the parties at the time of price settlement. Some reasons could include seller efforts, changes in business practice and environment, lumpiness, or seasonality. So really, it's important to understand what that normal level is at the very beginning of the M&A process, and up until the final date, track working capital to see, are we fairly accounting for the value of working capital? Because the owner could really could really extract as much cash out of that working capital before they really transfer ownership, and all of a sudden you need more working capital. Well, adjustments need to be made in order to account for that unnormal situation. So really, this is something that needs to be tracked throughout the M&A process. And unfortunately, there are many articles that talk about how M&A practitioners and the advisory team forget about it. And therefore, there's a loss of value, whether to the buyer or to the seller. So let's talk about working capital. Let's first define and review the formula. So working capital is current assets less current liabilities. The current assets are cash and cash equivalents plus accounts receivable plus inventory and other current assets, less accounts payable plus accrued expenses plus notes payable and any current portion of long-term debt that is due within the coming 12 months. Now, this formula can be adjusted to include or exclude certain accounts to more accurately capture the necessary working capital needs of the business. And we'll talk about this because that's very important. Working capital requirements versus the net liquid balance is a way to look at it. So working capital requirements is essentially the non-cash and non-interest paying current assets and current liabilities. And therefore, that's accounts receivable, inventory, less accrued expenses, accounts payable, and that's it. Because notes payable, the current portion of long-term debt, and cash equivalents would be the net liquid balance, right? So we can look at it from a operational versus financing perspective. And when you do that, the working capital situation changes, the needs of the business change, right? And so we'll talk about that. But let's first define that formula. Now, The key question, the most important question, is how do you determine, based on the current market projections, how much inventory and liquidity a business needs on transaction closing? What is that normal working capital level in order to ensure that when ownership changes from the seller to the buyer, the business can run at those expected projections? Seeking the necessary professionals is key to determining a fair value for this locked up cash. And that's why the Chartered Business Valuators industry, the CBV designation, is so important. Really, their training accounts in order to, essentially, they're trained to properly account for and project what that normal level is. That's why seeking these necessary professionals and paying that fee is very important to ensuring that you, as the seller or the buyer, are really buying at the correct level. Now, using industry studies and averages for the respective company is a starting point. You can go on Stats Canada or in the United States on other databases in order to see that based on the most recent surveyed data, this is how much businesses in your industry on average hold, whether it's in accounts receivable or cash and cash equivalents or in debt, right? And so working from those averages, you can then look at the respective business. And then you can pinpoint, based on the size and geographic region of the company, how other competitors manage working capital, and then they can kind of draw conclusions. Is there anything unique about the respective business which warrants a difference between the average in the industry and what the business has? If there is, then you need to recognize it and really talk to management and fairly agree upon that difference. And if there isn't, then you need to flag that and say, hey, there's extra there that shouldn't be, that's not needed to meet projections, and therefore we need to make an adjustment for that. So that process is incredibly long, and I won't go into that part of it. I'll go into, giving you an example, but that side of the discussion is very, very long, and it comes with a lot of experience. So while the due diligence itself is very complex, the difference between large and small firms is clear based on their access to capital markets and leverage with suppliers. So although I won't go into the specific data with regards to different industries and how accounts receivable and accounts payable differ, it is clear that if you are a large company buying a small firm, there are clear differences. Larger firms have a higher percentage of account receivable relative to smaller firms, so the amount of receivables is higher with bigger firms. Conversely, cash and current debt as a percentage of total capital is higher for smaller firms, and that's usually a buffer to really protect against the much higher risk for those smaller firms. So this points to a clear synergy. If a larger company acquires a smaller competitor, it can influence its working capital strategy to extract some real cash benefits. And what essentially that means is reducing working capital. So larger firms usually have smaller working capital balances, which is essentially the difference between current assets and current liabilities, because they have more control over when they receive their cash and when they pay out on their accounts payable, versus smaller firms which don't have that negotiation leverage with their suppliers, and therefore that cash cycle is less in control. So when you acquire a small business, you then can impose your size to improve their working capital strategy and therefore improve and realize that synergy. So I did want to touch upon that because that's a clear benefit which can be accounted for in the purchase price, but usually is much more speculative and will not be accounted for. So that's not something that would really increase the purchase premium for the business, but something that can benefit the buyer. So now let's talk about that relationship between working capital and the going concern valuation. Now remember, going concern is essentially the statement, the affirmation that a business is able to meet its obligations and operate for the next 12 months. So M&A practitioners often miss the critical connections between going concern business valuation methods and the level of working capital implied by these assumptions. For most going concern businesses, the current assets and liabilities transferred on the completion of a sale should be as close as possible to those required to generate the flows on which the valuation is primarily based. So this is essentially the most important statement you should take away from this. When you are valuing a business and you're looking at its working capital, you need to ask yourself, based on what I am projecting as an analyst in order to really warrant the valuation of this business and therefore its premium, do we have enough working capital to meet sales growth for the next 5 years, or really the question is for the next 12 months, because that's longer term working capital is a separate discussion and with regards to financing needs. But really the main question is for the next 12 months, if we're projecting 12% growth, can we meet that 12% growth? Do we have enough working capital, i.e. enough sufficient financing to pay our bills, and at the same time enough inventory if we sell goods to really meet that extra demand, that extra sales demand? If we do, therefore, we are good. We are properly accounting for the value of the business. But if we don't, then we can really find ourselves in a tricky scenario in the future. So it is common for working capital in the M&A field to be viewed on the basis of the operating accounts while excluding short-term debt and cash. And I talked about this, the difference between working capital requirements and the net liquid balance. So we're essentially taking away the net liquid balance from net working capital to only have working capital requirements. And so this is the formula for WCR, or in this case, net working capital in the M&A field. So we're removing all cash and interest-paying current liabilities. So now, really net working capital, especially in these examples and for these adjustments, is accounts receivable plus inventory plus prepaid expenses and other current assets less accounts payable plus accrued liabilities plus other current liabilities. So we've taken away cash and cash equivalents and notes payable and the current portion of long-term debt. So the inclusion of these accounts, essentially, when you include debt and cash, it tends to obscure the underlying relationship among working capital accounts in comparison to income statement flows. So, often a purchaser will argue that a cash buffer of some magnitude should be included as part of the ongoing working capital transferred on the sale of the company without any adjustment to the purchase price. So when I say we can exclude short-term debt and cash, that's not a hard rule. In certain situations, the buyer may say, hey, you know what? We should hold some of that cash. That cash shouldn't be used to pay down debt quickly and essentially we inject future cash. We're buying some of that cash in order to run the business, and we're not going to really account for that cash in the valuation because that respective cash is part of ongoing operations which we are acquiring. So it's a really touchy subject, and that's why a lot of people avoid it, because it's not clear. There's no clear rules with regards to, do we include cash in the working capital of that business and therefore the ownership of that working capital, or do we exclude it? So the rationale is that it guards against volatility during the course of ordinary business. So for a purchaser, if they somehow are able to negotiate to acquire some of that cash as ongoing working capital, then it makes sense. It can be a buffer. Now, an interesting case is when a business collects regular deposits for work performed in the future. Though these arrangements account for deferred revenues that appear in current liabilities. Does the purchaser assume these liabilities, or does the seller pay off those liabilities once they receive their money and really kind of transfer ownership, right? So that's another big question, and we'll account for that because there's a clear rule or question to ask yourself, right? Is it part of ongoing operations, or will it not be part? If it's common in operations, therefore you're acquiring ongoing operations, and therefore the buyer should assume those liabilities. But if it's a one-off deal, well, no, that's the seller's responsibility. It's not part of the business that the buyer is acquiring. It's part of the seller's decision, and therefore the seller should assume liability. So again, there's a lot of stuff, and that's why all the time people put off these discussions. Now, the real issue should be to determine what the ongoing net working capital position is likely to be going forward. If the deferred revenue represents a one-time business transaction, it is reasonable that cash should go to the obliger responsible for delivering the business. Now, in this case, the logic is applied to all potential payable disputes. If the payable is common and arises frequently throughout operations, the buyer assumes responsibility, whereas if it's a more unique charge, the seller bears responsibility. Okay? So now we've kind of talked about it. Let's actually look at a full example. So this is Home and Trade Inc. at H&T Inc., and this is going to be the business that we're going to look at. So the key takeaway from what we talked about in the first half is the level of working capital to transfer on sale should be what is needed to continue running the business, no more or no less, because that difference should be adjusted for in the purchase price. In addition to industry averages, referencing the historical statements of the company provides a perspective on what the normal working capital levels of the business is. So consider H&T, a retailer and distributor of hardware and home renovation products. Sales are typically weaker in the months of October through March due to lower activity in the construction sector, whereas through March to October, the construction sector picks up, spring season, and therefore new home builds, and therefore demand increases. So in addition, weather and lumber prices can impact sales. And so it's important to account for that variability in sales because we talked about this. As sales increases, the working capital needs increases. You need to stock more inventory, your accounts payable and your accounts receivable increase because you're now making sales and you're acquiring more supplies. And so all this increases net working capital. Whereas in the lower and weaker months of sales months, accounts receivable get paid off, accounts payable get paid off, and inventory declines, right? So that's really why you need to identify the cyclicality of sales. So the seasonality of the business is clearly visible once we analyze the working capital accounts of the business. Starting in spring, as the construction sector picks up, driven by higher sales, H&T's inventory and accounts receivable balances increase, and working capital only starts to decrease once receivables taper off near the fall months. So pay attention to how net working capital, including all accounts, remains fairly stable and in line with 12-month averages, illustrating that balancing out of net working capital. And so I'll talk about this. This is important. We should right away talk about it. So here is the net working capital schedule for the company from June 30th, 2012 to June 30th, 2013. So a 1-year schedule. Now, the assumption in this example will be that we are acquiring the business on the last day, June 30th, 2013, that we've negotiated the price and this is it. And that's unrealistic because if we're negotiating the price and we determine that the normal level should be based on this date, well, the closing will be in 2 or 3 months, and therefore that normal level will change. But for simplicity's sake, let's assume that the closing date of the transaction is June 30th. Okay, so here we have for current assets, we have cash, trade and other receivables, inventory, and prepaid expenses to give us total current assets. And right here at the end, on the right-hand side over here, this is the 12-month average for those respective accounts. So then we have current liabilities. So we have a bank overdraft and operating loans, the current portion of long-term debt, trade payables, warranties payable because they are a goods business, current taxes payable, dividends payable, and additional provisions and contingencies, which essentially is legal fees related to a previous dispute that H&T had. And so that will give us our total current liabilities, and all the averages for the 12 months are there. Now, the difference between total current assets and total current liabilities is the first line. So it includes all current accounts. So net working capital, including all current assets and all current liabilities, that net difference is right here for June 30th, and the 12-month average is right over here. Now, excluding cash and funded debt, which is essentially what we are assuming usually in the M&A sector, we remove that net liquid balance to only get our working capital requirements. So we remove cash, the bank overdraft, and the current portion of long-term debt. And so when we subtract that, the net working capital changes. So it increases, in this case, these are in thousands of dollars. So it increases net working capital from $97 million to $141 million. And so does the average. Now, if we were to exclude cash, debt, taxes, dividends, and provisions, then that net working capital will also change. And we'll talk about why you can actually exclude these and why it makes sense. But essentially, I don't want you to look at all of these numbers. What I want you to focus on are these 3 numbers and their respective averages. So when we look at net working capital in general and account for all accounts, there is a clear difference between the $101 million average and the $97 million average. So in this case, the business is underfunded relative to its normal levels. When you are excluding cash and funded debt, which is usually what's done in a transaction, the business is actually overfunded. Its net working capital is $141 million, whereas it only needs, in June 30th, around $116 million So what happens is that in this case, if we're to close the business without any adjustments, there's actually real value that's being transferred unfairly from the seller. The seller's not being fairly compensated for this extra value tied up in net working capital. And therefore, this is where we need to focus on making those adjustments. So you can pause the video if you want and take a look at the numbers, but I'm going to be making references to these numbers. So because the difference between the average annual net working capital and the balance at a specific date has a lasting effect on the funding needs of the business, it should be the basis of a price adjustment to the extent of the difference. So this is what we need to talk about, this adjustment. In addition to the pattern of cash flows, there may be unusual events or practices that have occurred during the reference period. If so, it will be necessary for parties to agree on adjustments to the data. So in this case, let's look at inventory. So inventory is relatively high at 164. The average for the 12 months is 138 million relative to 164 million. So there's a lot of cash tied up in inventory. Maybe this business took advantage of a price discount. So if they ordered more from their suppliers, they'd receive a discount on the per unit basis. So if they took advantage of that relative to what they actually need, well, they locked up some of that cash in the business, right? And so you need to account for that. Right? So maybe that's one of the problems for this respective example. So let's take a look. So there is logic, however, to suggest. And so when we're comparing this, I'm essentially in this example comparing what the business currently has on June 30th, the closing date, relative to the 12-month average. But remember, in certain instances, it's wrong to look at the 12-month average as the normal working capital level. In this example, I am because it's simpler. But again, we look at industry statistics, we look at averages for our competitors. So there's a whole due diligence process. It's quite a long time to really determine what that normal level is. And there is logic, however, to suggest that a reference working capital number based on a 12 months of history may understate the current needs of a growing business. If the business has been growing at 20% a year, a reference based on the previous 12 months may warrant a 10% lift to account for a half year's growth. So in this case, if the business is expected to grow by 20% its sales in 2013, well, the working capital needs of 2012 are significantly less than what the working capital needs of 2013 are. So in a growing business, it wouldn't make sense to actually look at the 12-month average because we're at the half-year mark. Maybe we should increase that normal by 10% to account for that 10% increase in sales. So failure to account for the working capital drain caused by business expansion may lead to increased debt financing with accompanying financing costs. So in a scenario where you don't account for that and you assume that the normal level is the 12-month average, well then when the business is acquired by the buyer will actually have to finance more inventory because they realized, oh my gosh, like we don't have enough to really fund this growth, right? And therefore they are unfairly paying a higher price for a business that needs much more injected capital. Okay. Now, although excluding cash and short-term debt may remain consistent with income statement flows, what about other current assets or liabilities? Because the business is changing ownership, the seller cannot fairly assume all accounts. So current accounts like long overdue receivables cannot be transferred due to risk allocation. It would be unfair for the buyer to assume these risky receivables and therefore they should not be paying for those receivables. And two, maybe there may be accounts that do not relate to the ongoing business and thus should be transferred over. As an example is income taxes payable. That's not relevant to the buyer. It's the seller's tax strategy where we have a completely different tax strategy. So I'm not going to pay for your taxes. So there are additional accounts. And again, there's a lot of discretion when it comes to this, a lot of negotiation. So when we're looking at this number, really we're going to work our way down to actually look at the $145 million net working capital number rather than the 141. We're going to exclude not only cash debt, but also taxes payable, dividends payable, and additional provisions because they are not relevant to the operations, the future operations of the business. They are relevant to the seller strategy, but not what I am paying for. I am paying for the operations themselves, not your individual decisions, right? And in that case, there is a larger discrepancy as well, which needs to be accounted for, okay? So returning to the H&T example, let's consider the individual accounts and make necessary adjustments. So in this example, you can argue that dividends payable, this represents a payment to the selling shareholder for profits earned and is a return of capital unrelated to ongoing operations. Therefore, it would not make sense to include this current liability in the net working capital calculation. So we should exclude this account. Another example is provisions and contingencies. So H&T has liabilities related to various legal actions in progress. Seeing that they are not common for the business, and because the seller is more familiar with these disputes, this account should also be excluded. So I'm going to jump back once more just to show you. So dividends payable, which is related to that payment to the seller, should not be included. So we shouldn't include this $2,000 that's paid out in these past few months, right? Which affects the average that we're looking at. In addition, provisions and contingencies. This $2.5 million should not be accounted for in net working capital because I'm not dealing with those legal fees. You, as the owner, are dealing with that, and with your related to your actions. It's not related to the ongoing business. So I'm going to exclude those things. Now, some other accounts would be warranties payable. So H&T offers limited warranties to its trade customers that provide an incentive to building contractors. Now, this is a competitive advantage that is seen as part of the ongoing operations of the business. So this account will be included. Because it's part of the business, we're going to include this. Now, what about taxes? Now, there's a lot of debate with regards to who should be responsible. In an asset sale, usually the seller is. However, with a stock sale, the buyer could argue that they are unfamiliar with the tax strategy, which will change with the ownership structure. Therefore, the seller should assume responsibility. But in certain cases, the seller, if they negotiate properly, can actually push that liability on to the buyer themselves. But I feel it's more common for the seller to assume this liability. So in that case, we include warranties payable, but we exclude taxes payable. So we can now look at the adjustments. So let's complete these adjustments. So for categories of current assets, we don't have any net cash and cash equivalents, so we are already excluding that. We include trade and other receivables, inventory, and prepaid expenses. All three of these current asset accounts are relevant to the future operations of the business. Now, the categories that we are going to include in the net working capital side from a current liabilities perspective is, because there's no bank overdraft, it's zero, so we're still excluding that. Trade payables and warranty payables are things that we're excluding. Now, going back to that working capital schedule, there was a lot more here. So bank overdraft we're not accounting for, the current portion we're not accounting for. We're accounting for trade payables, warranties payable. We're not accounting for current taxes because it's not part of our tax strategy. We're not accounting for dividends payable because it's related to the seller, not us, the buyer, and not related to ongoing operations. And we're not accounting for provisions and contingencies. So when we strip these away, the average changes from a $116 million working capital normal level to a $121 million working capital level. So the net working capital of the business on average increases when we exclude these. And so really, when we make these adjustments, I'll go back to the final slide over here. The subtotal for all of these values is $234 million in current assets, less $88 million. So our net working capital, the amount that we feel is fair to the ongoing business, is $145 million. So when making these adjustments, the past 12-month average is only 121 relative to the business's current net working capital of 145, signaling that an upward revision in the acquisition price is necessary to compensate the seller fairly. So in this scenario, the business is overstocked or has much higher net working capital than is needed to run the business based on the 12-month average of 121 million. Therefore, that difference between 145 million and 121 million, whether you realize that full difference in the acquisition price or you increase it by 80 or 70% of that difference, you need to make an adjustment to the acquisition price in order to fairly compensate the seller. Now, if the seller is completely unaware of this, then, well, you as a buyer can take advantage of that. Unfortunately, that's the business world. But if the seller is smart enough to recognize that there is real cash that is tied up in their net working capital, they can look at that difference between what they actually have and what they actually need, what the buyer actually needs to run the business, and they can actually extract some of that value. Because for the buyer, when they buy that business, they're going to have this extra net working capital. And if they manage their working capital strategy correctly, they can actually extract that difference from the working capital of the business that they just acquired. So not only are they paying a lower fee, but they're actually going to be compensated. So really the purchase price is revised down even lower for the business. So they actually benefit from that, right? So this is a very, very important adjustment in the real world space. Now, I will make one comment. It's very important to recognize that for large multinational companies that have many, many subsidiaries and operate in many geographies, it's much more difficult to calculate the normal working capital level. So these adjustments are much more relevant for mid-market companies rather than large companies. It's harder to justify that there is extra value tied up in the working capital of the business in a large multinational company because you just can't know. You as the acquirer cannot really determine, even through your due diligence and interaction with management, how much value is tied up in there. And really, if you're going to talk to management, their incentives differ from yours. They're trying to maximize the value of their business, not reduce it. So you're not really going to get clear information from the seller side. So you as the buyer, when you are buying large companies, will not be able to really argue these adjustments as strongly. Maybe you can, but in most cases, it's just too difficult to determine what the normal level of working capital is and which will be used to meet your projections. And therefore, this adjustment is not relevant to that. So in conclusion, inclusions and adjustments of working capital accounts cannot properly be negotiated outside the context of the other material deal points regarding value and transaction structure. They should be dealt with as early as possible in the M&A process. The three key steps are: 1, to determine what working capital is and the exclusions necessary. 2, calculate the amount of working capital needed around transaction closing. So determine how much that normal working capital level is in order to meet your growth projections, your valuation projections for the next 12 months, and then adjust the purchase price either upwards or downwards with regards to the difference between what the actual net working capital is of the business and what the necessary working capital of the business is. Okay. Other than that, that's pretty much it for today. Thank you so much for watching. If you made it through this video, please like and subscribe to the channel for more. I really, really love making this video because it is much more advanced and it really shows that there are so many different considerations when it comes to M&A. And again, I love the space. I really love delving into numbers and understanding the business and reading those numbers. So if you can really support the channel, I would appreciate it if you can share the video or really like and subscribe to the channel. If you have any questions, please comment below and I'll be sure to get back to you as soon as possible. Have a great day, guys. Thank you.